Hi, good morning, everyone. I'm Kristen Fix, and I'm on the executive committee for the Northwest Cider Association. Super excited to kick off symposium with this session called Proper Costing for Cider, hosted by Maria Pearman from Perkins Accounting. Welcome, Maria.
Thank you. Thanks for having me here. I'm really sad to not see you all in person, but um, my name's Maria. I'm a CPA. I focus on beverage alcohol accounting and finance, and I've been focusing on this particular industry for about 12 years. And I really enjoy working with folks who are in the beer, cider, spirits world. Um, my personal passion is the educational component of accounting and finance and helping business owners understand a little bit more about their business health through numbers. And a lot of times, this is an area that is not a forte per se of folks who are in the industry. A lot of people are passionate about creating their product and not so much the debits and the credits. And so my goal is to give you just enough information and education so that you can understand what the numbers are telling you and bring more of what you do best into the world. So a big part of that is the proper costing of your goods and understanding if you're making money on the cider that you're producing. So that's the focus of today's topic. We're going to talk about what goes into proper costing of cider, and then once you've got proper costing, how you can slice the data to make it more relevant and answer specific questions rather than just, and rather than are we making money? Are we making money specifically on this product, in this geography, in this sales channel? And then we'll look at a couple applications of that as well. So that's where we're headed today. And, today in the environment that we're operating in, it is more important than ever to be sharp with your data. There's a lot of stuff that's going on that makes it a very competitive time. Those forces are coming internally from within our companies, from within our industry, externally as well. Some examples of this are the COVID-19 restrictions, increased competition, and that results in more choices for the consumer, which then often results in a price ceiling. You've got the same shelf space with more brands on that same shelf space. Then you've also got distributor consolidation, so you're fighting for mind share within the distributors aspect. Fickle consumers, a lot of times there is shifting tastes and trends in the environment, and challenging access to retailers. And what I mean by challenging access to retailers is that some retailers are changing the way that they're buying. So, for example, with a large chain of grocery stores, in the past, it may have been that they had buyers who had, say, over, maybe 5 stores in a small geographic area. But what we're starting to see more and more is that the buyers are in control of a larger territory. So now one person is making decisions for maybe 20, 40, 60 stores. And that means that, you're fighting to get that person's attention and get your product on the shelf. So all of this, they're very real factors and you can't fight them. You have to accept them and then work around them. So it makes it even more important to understand if you're making money and what you're creating. So the first step in understanding what goes into cost of goods sold is to get a solid handle on what those components are. Fortunately for the beverage alcohol industry, we now have a cost of goods sold manual that the Brewers Association put out. This was published in June of 19. And if you're not a member of the Brewers Association, it is a member resource. I would highly encourage you to become a member to get access to some of these materials. Even though it's not specific to cider, there is a ton of relevant information there that will help you run your business well. So the cost of goods sold manual takes you through all the components of expenses and dials into what should be included in cost of goods sold and what should not be included in cost of goods sold. And this is important because when you kind of scan the marketplace for beverage alcohol, companies have been counting COGS in different ways. And so it's very difficult to get an apples to apples comparison of how one company is doing versus another because You might have a third of the market that is counting only direct materials into their COGS. You might have another third that is properly including direct labor, excise tax, overhead, and then another third that is doing somewhere in the middle. And a lot of this comes down to how robust your internal accounting department is, or your resources internally to get the record keeping right. If you're doing cost of goods sold, correctly and doing it as correctly as possible, it honestly can take a lot of effort to get those numbers right. So it always has to be a balance of, is the data that we're going to get out of these efforts worth the cost to get to the point where we've got good data? And that's always a judgment call. It's going to be different for every business. I would say it's more onerous for small businesses, because in small businesses, usually you have fewer people wearing more hats, and just resources are thinner than in a more robust company where you might have 2 or 3 people in an accounting department. Nonetheless, I want to show you kind of best case scenario so that you have an idea of what to shoot for. And if you ever, lose your way or forget what you're shooting for in terms of costing, I highly encourage you to go back to this BA Cost of Goods Sold manual. So in sum, it provides a common framework for non-technical and technical accountants, as well as owners, cider makers, and managers to develop your internal costing systems. So in a nutshell, you've got multiple components that go into cost of goods sold. Raw materials and additives, that's pretty low-hanging fruit. Everybody kind of understands that one. Production labor, so this is the wages related to the people who are making your cider. Excise tax, manufacturing overhead. So manufacturing overhead includes things like, a portion of rent, utilities that go into the production facility. So for example, if you have a tap room in a production facility and it's 25% of the square footage is the tap room and the remainder is production facility, then the 75% of rent that relates to the production facility would be considered overhead for making those goods, and it would go into COGS. And then depreciation as well. And depreciation is the cost of equipment over time as it ages. So if you have a tank and that tank has an expected useful life of 10 years, 1/10 of the cost of that tank is going to be expensed as depreciation every year. And a lot of times you'll see businesses that just have one line called depreciation expense, but that might capture the tanks and the production equipment. It might capture the computers that are used in the office or by salespeople. It might include furniture in the tap room. So if you have all of your depreciation in one place, you're not parsing out the portion related to making the good that you're selling. So this idea is we're going to carve out just the portion of depreciation that relates to the equipment we're using to make our good and put that into cost of goods sold as well. So again, that first line of raw materials and additives, probably table stakes for most of you all, but some of these other components might be a new way of thinking about COGS. But it truly does, when you measure COGS in this way, it shows you the true economic reality of the cost of what you're selling. So I've included here a list. It's a very detailed list, but it's a great resource to consider what goes into COGS, what doesn't. So your materials, and that includes, of course, the ingredients, but also the packaging materials, any freight associated with bringing that to your production facility, and taxes, like sales taxes that you might pay on the materials you're using to produce your goods. That all is considered materials and classified as COGS. Then in the next section, we've got wages. So when I say labor, what I mean is wages, taxes, and employee benefits. Employee benefits would be 401k contributions, health, dental insurance, things of that nature. So for your direct production personnel, your cider maker, cellarman, packaging line, all of those people are COGS. Your maintenance and engineering staff is going to be classified as COGS. Warehouse personnel, director of operations, lab quality control, that all is considered cost of goods sold. Then you get into departments like sales and marketing, IT and HR, taproom staff, administrative staff, officers. So officers are usually owners, but not always. An officer could be a president, a CEO, regardless of whether he or she is actually an owner. So those types of personnel are not included in COGS. And I often get the question of how logistically do you parse out your labor? Best scenario is to break out departments in your payroll realm. So if you're working with a payroll processing company, you want to have departments, and then employees will be coded to different departments so that when you are on the court and you are actually recording your payroll expense in your books, you'll be able to take departments A, B, and C and put that into cost of goods sold. And then you'll have departments D, E, and F that are considered overhead, and those will go lower down in the P&L as part of operating expenses. So the key in this is to have departments classified in your payroll structure with your payroll processing company. And if you are doing your own payroll, you can achieve the same thing. It's just that you're going to have to go through the effort of creating departments, and then ideally whatever software you're using, you'll be able to pull department reports and use those department reports to book the payroll in the right place. The next slide talks about portions of overhead that you're going to put into COGS. So everything on this list should be considered COGS to the degree that it relates to your production facility. So rent, we just talked about that, and that should be a portion of the rent that's related to the production facility should be classified as COGS. Same with utilities. Now, logistically, utilities can be a little tricky because, the question is, well, how do I divide my utilities bill correctly between what relates to COGS and what relates to admin or tasting room? And in a perfect world, you would have different meters, but understanding that that might not be realistic for everybody, again, you could come back to dividing it up based on square footage. And that in itself is a bit of an imperfect science because water, for example, you know that, again, if you've got 25% that's tasting room, 75% that's production facility, your production facility is taking more than 75% of the total water bill because it's using more water than the square footage of your tap room side is. So there are parts of this that, depending on the sophistication of your setup, there might be, it's going to be a bit of an estimate, but you just have to find the path that allows you to get as accurate as possible without being burdensome to your organization. I can't in good conscience tell you that every cidery out there needs to go out and change things and make sure that they've got a separate utility for every part of their organization. Because it's just not practical. So you as a business owner, as a manager, need to make the call on where the trade-off of being practical and useful meets. It's a cost-benefit analysis. Excise tax, on the other hand, this is one where it is 100% COGS. There's really no debate about that. So excise tax, you can either build it into the bill of materials so that it becomes part of the cost of the good that you're selling, or you can book excise tax as a separate line item within cost of goods sold. Product-related insurance, there's about 1 million different types of insurance that a business can get, but most often businesses that are making goods, especially consumables, will have some type of product-related insurance so that it's protection against if something goes wrong with your cans on shelves or something of that nature, that you're protected. So that product-related insurance should be considered COGS. Any dumped product is COGS, vendor returns, depreciation on production equipment, memberships and subscriptions. So I want to talk about this for a sec. Memberships and subscriptions to software primarily that relates to your production. So if you have inventory management software, that would be included in cost of goods sold. If you have a sales support software like VIP, that is not COGS. So it depends on the nature of the membership and subscription, to which you are applying, whether or not it belongs in COGS. Consumables, service and parts. So these are things like hoses. That is going to be considered COGS. Cidery supplies, any other kind of miscellaneous departmental supplies, repairs and maintenance, test batch cider costs, pallets, process improvements. So all of those are elements that go into COGS. And often when I give this presentation, a lot of people become kind of overwhelmed with how much cost is going into COGS, and it seems frustrating because once you tally up all these items, then the gross margin percentage goes down, and that can seem frustrating to a lot of people. But I understand where you're coming from, and I would rather you understand a realistic idea of what goes in COGS than to be disillusioned about what it is. So this is a slide that walks you through how goods move through the inventory cycle. So when you first buy raw materials, for example, it is an asset. What you have done is swapped cash for raw materials. And it is not yet a COG. Both of those things, cash and raw materials, are both on the balance sheet. They're both assets, and it is sitting there. When you purchase raw materials, it has not yet affected your income statement. So that raw materials that you purchase is going to move through the production process, and it stays an asset all the way through the production process until a finished good is sold. So once you start the cider making process, it goes from being a raw material into WIP, which is work in process. And then finally, you've got a finished good. And it's not until that finished good is actually sold that the cost of that raw materials moves on to the income statement as cost of goods sold. And the same thing is true with direct labor and overhead. That is all considered an asset. And then you work through the process, creating a finished product, and it's finally expensed when that finished product is actually sold. So this is, again, an area that can be confusing, especially if you're thinking about labor. So let's take that, for example. It's March 16th. Let's pretend that I just ran payroll yesterday. So I have spent money. I have paid people. That is a real outflow of cash. But if I have spent $10,000 in payroll, 5,000 of that is considered related to production. What I'm telling you is that $5,000, half of that expense, needs to be captured as inventory, not yet an expense. So it can be difficult to wrap your head around and think about, okay, I need to capitalize that labor until it becomes a finished product. And the mechanics of that, if you were looking at the bookkeeping, you essentially would book all of the payroll expense and then do an adjustment to put half of it as part of an asset in inventory, which eventually you will take it through the process of becoming a finished good and expensing it. And if you have specific questions about how to make this work in your environment, on your books, let me know and we can talk about that offline, because you are going to have to create kind of a holding account that will then clear as the goods are sold. So it's a little bit outside of the scope of what we're talking about today, and it can be complicated, but if you're interested, I can certainly talk to you about that. And my information will be at the end of the presentation. Okay, so that's how all of these components of COGS start as an asset. They move through WIP, they become finished goods, and you expense them. So once you've got your COGS in line and you're accounting for everything properly, then you've got good relevant data. And having good relevant data is critical to helping you make business decisions. So some of my most favorite reports to look at are a little bit different than the standard income statement or balance sheet that you might be used to seeing. So we've got, your standards, which are balance sheet, income statement. But what I find to be more helpful is budget versus actual reports, period over period comparisons, income by revenue center. So when I say revenue center, what I mean is your production facility and wholesale sales versus taproom sales, income statement per barrel, and then income statement with a percentage of revenue. So we'll look at examples of each of these. So this is a collapsed comparative income statement. And when I say income statement, that's synonymous with profit and loss statement and P&L, all the same thing. So I am big on budgeting. One of the first things that I cover when working with clients is whether or not they have a budget, highly encouraging them to do the work to prepare a budget, because without one, you're completely in a position of being reactive to your financials. So building a budget is really important to make sure that the company's overarching goals, that the actions you're taking as a company support those goals, and that there is alignment there, and that every department's actions are aligned to the same goal. And also, it's really helpful when you're looking at actual versus budgeted data. You can see where you're off. The point when you're reviewing budget versus actual is not necessarily to form judgments, but rather to understand why numbers are different than what you expected. And then from there, you can decide what kind of changes need to be made to push you closer to your desired outcome. So you'll notice as you go down the first column that I don't have every single line represented on this income statement. It's more the highlights. There's revenue, discounts, net revenue, COGS, gross margin, sales and marketing is one big bucket, brand contribution. So brand contribution represents basically your gross margin minus sales and marketing. And brand contribution means how much is left over to cover the overhead costs for the company, to cover, any other operating costs. Then after that, we've got overheads and admin costs. So this is kind of like the required maintenance that keeps the engine running. It's not necessarily related to selling the goods. And then EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So I separately state that, and then underneath that, I list out those elements of EBITDA: interest, taxes, depreciation, amortization, and we arrive at net income. The reason why I highlight EBITDA as a separate line item is because it is so often used as a barometer for financial performance. And often companies are judged on EBITDA by either the ownership group, potential investors, lenders. So it's a really helpful metric to get eyes on month to month. Also, it gives you an idea of the valuation of your company. If you're interested in M&A activity, mergers and acquisitions, if you're thinking about selling your company, quite often those deals are structured as, so the sales price would be X times your rolling 12 or rolling 24 month EBITDA. So for example, if you're tracking EBITDA over a course of 12 months, you can take a look, get a sense of what your average EBITDA is, multiply that by a specific multiplier to get a sense of what your enterprise value for the company might be. Now, that is far from a scientific approach, but it's quick, it's easy, and it gives you, as a business owner or as an interested party, a sense of if the value of your company is moving up or down. So at any rate, I guess my point is you don't have to look at every single line item to make sense out of the P&L and to get useful information. But I really encourage you to look for a particular month. If we wanted to look at February's review of numbers, we would take February actual versus the budget and look at the variance in dollars. And so, as we're going down, we're just trying to understand, do we know why this variance occurred? And do we need to take action based on that variance? And then you move over to year-to-date actual. So you're getting a sense of the cumulative activity of the company. And then the third set of columns is the fiscal year forecast. So the fiscal year forecast takes the actuals year-to-date and marries it up with the budget for the remainder of the year. So in the column that says fiscal year forecast, this is going to be the actuals for January and February, and then budgeted for the rest of the year. The middle column of fiscal year budget is going to be just purely the whole budget for the year. So budgeted January, budgeted February, budgeted for the rest of the year, and then of course the variance. So it gives you a sense of if we can pull these other months back in alignment with our budget, this is where we're going to end up for the fiscal year. So that can be really helpful. Another way to look at your data that is useful is the income per barrel. So in this situation, you're taking all of that stuff that we just looked at, but boiling it down to a per barrel number. And so to achieve this, you would take the data that's in this slide we just looked at, and basically, so for the February numbers, you would divide the February columns by the production in barrels for that month. And then on the year to date, you would divide it by the year to date production numbers. And for the fiscal year columns, you're going to divide these numbers by the number of barrels that you're projecting to produce for the year. So when you do that, it's helpful because it breaks it down into like bite-sized chunks. So you can get a sense of where metrics are maybe out of whack and where you need to put some attention. And it's the same type of information. I've got a little more detail in this slide than I had on the previous one, because you can now get a sense of whether these numbers are appropriate on a per barrel level. Another way to think about this is expense categories as a percentage of revenue. So sometimes you can get lost in the weeds of financial reports because you're just looking at big numbers and they kind of lose their relevance when you don't have a sense of what am I shooting for. So as you look at your expense categories as a percentage of revenue, percentages can be a really helpful way to take complex information and boil it down to a key performance indicator or a share number that makes sense. And it's a little more relevant than just a sheer dollar amount. So if you look at this, you know, we've got percentage of revenue where total revenue is always going to be 100%. And then you're measuring each line item relative to that total revenue number. For sales discounts, we're saying that February actual sales discounts was 12% of total revenue for February. And we have budgeted to only have 7% of total revenue with sales discounts. So we really need to figure out, do we need to go on a discount budget, or did we overspend on discounts, but yet it was worth it because we made it up in EBITDA? So as you go down the list, you're looking at total COGS is next. So even though we were over budget on our sales discounts, we were under budget on COGS as a percentage of sales. And the net effect is that our gross margin was spot on. So we can see that even though we went over on one area, we were under in another area, but we came out the same. So maybe it's not that big of a deal. And then you keep going down the list looking at sales and marketing. So we actually underspent on sales and marketing versus what we had planned on. And thus we had a little more left over, 42% versus 39% for brand contribution, which was available to cover our overhead costs. We had 13% of total sales in overheads and admin. And so we ended with an EBITDA for the month of 29% versus 26%. And, you know, and then you can just follow this type of analysis through the different column sections that you have to get a sense of you're honing in first on 1 month, and then you zoom out a little bit and get to see the performance of the company year to date. And then you can zoom out a little further and see, are we on track? Like, where are we headed at the end of the year? Where do we want to be headed? Where are we headed? And are we on track? And so it's really helpful to break it down into a simple presentation that allows you to make decisions quickly without getting lost in the minutia of lots of numbers. So for those reasons, I like these types of categories. Income statement by revenue center. If you have a production facility as well as a tasting room or a full-blown restaurant where you sell your cider in the restaurant, I highly recommend using classes or divisions within your accounting system to break those out separately. So in this situation, when we have classes, we can actually sell our goods at an arm's length price to the other side of our house. In this situation, we've got a cidery, which is a production facility, and we have a pub, which is a restaurant where we're selling our cider. And we want to be able to take the cider that's produced in the production facility, sell it at an arm's length price over to the restaurant, because when we look at the performance of the restaurant, we want to see the true economics of that. And if you don't do this intercompany sales, then what you're left with is you get an income statement for the restaurant, and it looks like the restaurant's doing amazing, but it's really not paying market price for the cider that it's selling over the counter to its patrons. So it's looking really rosy when in fact it might not be. And the other side of the coin is that the cidery, the production facility, is not getting credit, if you will, for the cider that it's selling to the restaurant, because without this intercompany sale, that is only being credited to the restaurant. So to achieve that, we create an AR invoice that is created by the cidery, and it is quote unquote sold to the pub. So you're left with accounts receivable on the cidery side. And let's say that the cidery sells $300 of cider to the restaurant. So you've got an AR invoice to another department, and then the restaurant should pick that up as an AP invoice. So now you're left with a bill that the pub is recording in its department from the cidery for $300. So you've got an AR invoice on the books for $300, an AP invoice on the books for $300. And now you need to close those and like pay each one of them. So in the reconciliation process at the end of the month, you will pay the AP invoice, you will receive payment for the AR invoice, and this is going to wash through the administrative class. So you can see in this example, the cidery has sold $23,000 of $23,290 of cider to the pub. And the other side of it, so that's positive revenue for the cidery, but the other side of it is washing through administrative. By the same token, the restaurant is picking up $23,000 of COGS because they're buying this cider and then selling it across their counter. The other side of that is a negative $23,000 COGS in the administrative class. So the effect is that when the negative income and the negative COGS in the administrative class are netted against each other, it's a $0 effect. But you have now allowed the cidery class and the pub class to reflect the true economics of their departments. But yet you're not double counting income. So by creating this intercompany sale, we can pull a report by class, see the true performance of each division without muddying the water globally for the enterprise. The enterprise income and COGS is correct. The departmental income and COGS represents the economics for each division. And so you can pull it apart and see each side of the house as if it were standing alone, or you can consolidate it. Total is representative of the whole. Now, the total expenses that you see of $25,969 in the administrative column, those are the types of expenses that are purely administrative to this company. And, you know, for example, it might be an office manager or legal services or something that benefits all sides of the house, and it can't necessarily be divided between cidery and pub. So when you look at the administrative class as a whole, usually that's going to be a loss because there is no income or COGS. It all washes to zero every month, but then you do have some expenses that are just to keep the engine running, if you will. But then the total column over on the right does represent the enterprise-wide economics of the organization. So dovetailing on that presentation is that you have different financial benchmarks for each line of business. So what you would expect in terms of gross margin for a production facility is going to be different than what you would expect for gross margin for a cidery restaurant or a tap room, because one is manufacturing production facility where you're making cider you're going to sell, that is manufacturing, versus a restaurant or a tap room, that's a service model. And it benefits you to have two classes or departments, because if you look at your blended gross margin, it's not helpful at all because it doesn't really speak to either of those sides of the house. So to separate them is going to give you clarity and help you see, okay, my production facility has gross margin of 20%, and I know that's way less than what I need it to be. You know, I need it to be closer to 40%. So there's a problem, versus if you just have that blended with the service line of business, you can't tell where you need to make changes. Also, management can compare the performance of different business lines to your correct industry benchmarks. And again, that cider being sold to a pub or tap room, you need to record that at an arm's length price, because without it, you've created this false expectation of what the margins for that division should be. So on to a couple key ratios I recommend that businesses look at monthly. Gross margin by brand. So this means that you're like if you have a dry and a semi-sweet, you're looking at the gross margin for dry versus the gross margin by semi-sweet. And that's really important, again, getting down to the razor's edge of data so that you can make better decisions that are rooted in very relevant information. Looking at average gross margin by pack type. So you're looking in terms of case equivalents for draft cans and bottles. How much money am I making on each of those pack types? Profitability by distributor will show you if you're making money when you send your product out of state. Oftentimes, the further you go, the less profitable a good is. And so an easy way to look at that is by distributor, because distributors have geographic footprints. So it makes it easy to kind of drill down and say, you know, I'm going to look at my profitability for distributor XYZ, and that'll tell me what I'm making when I send my product to Virginia or wherever it might be. Gross margin of retail sales. So when I say retail sales, I mean direct to consumer. You're selling over your own counter, and your gross margin for the sales over your own counter, you expect to be a lot higher than your wholesale sales. That is when you sell through a distributor, or you're selling to, you know, if you're self-distributed, you're selling to a restaurant or other off-premise location. And you need to measure the gross margin of your retail sales separate from wholesale sales, because they have different cost structures. And if you just have everything blended in together, it's kind of mush, and you can't tell where you need to make changes, if any. We talked about EBITDA. I highly recommend keeping an eye on that month over month. And some people get confused about how to measure it. But if you ever get confused, just follow the title. So earnings before interest, taxes, depreciation, and amortization. It means that you're going to start with net income and then add back each of those components: interest, taxes, depreciation, amortization. So one caveat is that the taxes in this does not include excise taxes. It really is in reference to income tax. Net income, of course, is important to keep an eye on, and then your monthly burn. So this is going to be payroll, rent, debt service, which means how much you're spending on interest and principal on debt owed, average operating expenses, and then fixed costs that are in COGS, such as salaries. So the idea is, like, if all sales stop tomorrow, how much should I expect to need to continue to spend on a monthly basis to keep the operation going? And then from there, like let's say that you do the math and you figure out that your monthly burn is 50 grand, then you can use that to start to calculate how much of a safety net that you want to have in cash. And I recommend that that's kind of minimum of 3 months. So once you know what your monthly burn is, then you have an idea of how much cash should I have on hand. So practical applications. I'm going to give you a couple examples here. So you can leverage data to make smarter sales and marketing choices. In this example, Cidery Awesome has two products that are equally popular, a cider and a Perry. They have production constraints, can't produce enough to satisfy the market. Without data about the cost per brand, they won't know that one product is more profitable than the other. And if you do have proper data, the cidery is in a position where they can make a more informed decision and use the limited production capacity to generate the more profitable product, which results in more margin dropping to the bottom line. So it's important to have that very specific data so that you can make business decisions that allow your company to flourish. Another example is using data to drive accountability within your company. So Happy Hour Cidery has a production facility that sells cider to wholesale accounts, and they also have a pub with full menu. They're profitable, but management feels that the pub is underperforming, although they can't really tell why. And without data on performance by line of business, they won't know that the pub is losing money and is overstaffed. Therefore, they can't hold the pub general manager accountable. To remedy this, they adopt classes so that management can see the performance of the production facility separate from the production of the pub. The cidery begins selling product to the pub at an arm's length price, which results in more realistic representation of the pub's economics. So the result here is that areas of weakness are identified and clear instruction is given to the general manager. The company now knows what needs to be adjusted to make the pub profitable and successful. So that was kind of a blitz of information. I wrote a book that was released in 2019 called Small Brewery Finance. This was written for the Brewers Association, and you can find it on Amazon. Even though it is titled Small Brewery Finance, a lot of the information in here pertains to ciders or other small craft beverage manufacturers. So if you're looking for a resource, it's a good place to start. You can get it at Amazon. Also, through the symposium, you can get 20% off. And to take advantage of that, you can send me an email. There's also a place in our booth in the symposium vendor hall where you can put in a request for information about that offer. There's my information. I would love to hear from any of you. I think we've got 2 minutes. Do we have questions?
Hi, I'm here. Yeah, we do have a few questions actually, Maria. Let's see. John asked, he was wondering when you were talking about the barrels for the BBL calculations, if you would convert cases to barrels for the income, or if you could leave it separately as cases.
Yeah, you could do that by CE. That's totally fine.
Next, Rhonda wanted to know, would offsite storage of inputs such as bottles and ingredients apply to COGS?
Yes. Yep.
Great. All right. Eric is saying he lives in Washington State, and he's wondering about the ARAP invoices from Cidery to Pub.
Mm-hmm.
He was wondering if that in $300 of invisible sales would if he's going to turn around and sell all of that cider to consumers, the COGS showing on my retail operation will hit my books, but not my sales tax reporting. So he wants to know, does he have to factor in that calculation when he reports sales to DOR?
Yeah. So when you're reporting, you would use the enterprise-wide numbers, which would which would kind of exclude that intercompany sales piece. So in other words, you would use the total column as opposed to reporting for one side or another. If for some reason you are only reporting one side, like if for some reason you're pulling data that is only one class, then you would want to back out that adjustment that you've made.
Okay. So he wants to know, would he just manually exclude those then?
Mm-hmm.
Okay.
I mean, I recommend having a work paper that supports the math so that if you are ever audited by this, you would have a work paper that could substantiate that adjustment and show, in other words, it's going to show why you made that adjustment.
All right, next question. A couple people asked this. They wanted to know, how do you arrive at pricing to the tap room, at that arm's length pricing?
So a lot of folks will just use the same FOB as they're using for distributors. Some people will choose a price between the manufacturing cost and the FOB. Like, I'm just using round numbers. If it costs you $50 to make, but your FOB is $100, they might choose $75 to sell to the tap room. So there's not a right or wrong there. My recommendation is to sell to the tap room at FOB because that's the same, well, similar to what the tap room would pay if they were purchasing this on their own. So, and even the tap room is still kind of getting a break, if you will, because it does not have the layer of margin that a distributor would charge to a retail outlet.
Great. All right, and then last question is from Rhonda. She wants to know if they're selling merchandise like glasses, t-shirts, coasters, in addition to cider in the tasting room, should that be considered a separate business like the pub tasting room analogy?
No, no, but you just want to have it separately stated in the line. So in a tap room, you're going to have draft sales, retail sales, which usually means cider to go, food, and merch. So you just want to have it as a separate line item in the income section and also in the COGS section. So in COGS, you would have, merchandise COGS that you would compare to the merchandise revenue that's up in the revenue section.
Great. That's perfect. And we are just about out of time. So thank you so much, Maria, for being here. I put your email in the chat. So if anybody wants to copy and paste it from there, they can get in touch with you. And we really appreciate you being here so much.
Thank you. Come see me in the booth. We'll be around and would love to chat with you.